and welcome to the Amber Data Derivatives podcast. I'm here with Artur Sepp, who is the head quant of Clearstar Labs, which is a family office focusing on DeFi and crypto option strategies with a delta neutral bias. Artur, how are you?
Good, Greg.
Well, thank you so much for coming on. You've been a presence in the crypto vol space, so it's really great to have you on the podcast. I was wondering, before we sort of jump into what you're working on right now and what you've been doing in crypto and crypto vol, maybe we could just get like a quick background. What did you study in school? How did you sort of manage your career up until this point? Just briefly, some of those touch points.
Mhm. Well, I did my undergrad in economics. It was fairly mathematical, and I also studied finance theory, including Black-Scholes, including Markowitz, and I was very fascinated by, I think, modeling aspect that you can use math and data and do some investment decision out of it. So, and later I wanted to to continue with that, and I wanted to get more background, more say a quantitative background in finance, right? And why I joined, I did masters in statistics, and I also continued with PhD in statistics. And meanwhile, I also studied engineering at Northwestern University. And I was always fascinated applying math, like applying like numerical, stochastic calculus to solve fascinating option problems. And yeah, here we are.
That's fascinating. So yeah, I saw that you actually went to Northwestern in Chicago, essentially Chicago area. And so when you were studying probabilities and statistics over there, did you know that you were going to apply it to derivatives, or was derivatives one of the potential
It's
paths?
actually, yes, I think so. So after 1 or 2 years after my master's degree, I saw like that there is this quant finance community. At that time, there were a couple of blogs like Wilmot blog and nuclear finance blog. So I was kind of very good, like to see like real quants and to see problems they're solving. And also, I mean, it was quite lucrative, right? You at that time, people with this kind of heavy maths skills were in high demand, and why not? I thought, okay, this is what I want to go, what I want to do, and I think it's fascinating. And that you also, I think, that you can say make money on these hard skills is good for say for scientists is good, right?
Yeah,
So yes, I from pretty much from early on I knew that this is what I want to do.
yeah, that's great. That is one of the interesting things about finance is that you could do these math problems and you get instant feedback. You see how it works in the real world as opposed to maybe doing like a physics projects that take 30 years to get some sort of conclusion to it. So after you did university, I saw that you went to B of A. You built out some option models for illiquid stocks and systematized a lot of the market making efforts. Is that right? And how did that go? And can you give us a little bit of details on that?
Yes, so we at Bank of America was many. I worked for many like teams, supporting teams. I think the most interesting, one of the most interesting projects were building up market making models for liquid stocks. And say usually the desk were making markets in options on emerging market stocks. And there are two. So first, it's a one-sided market. Usually, you have only buyers of options, right?
Oh, interesting.
And it was quite big size because usually, again, it was corporates or some sort of people who wanted to hedge their exposure. And the problem with those markets, delta hedging is difficult because you can move, if it's a big position, you can move market, right? You can impact your own position. On the other hand, it's hold to maturity, right? So you can do more like, say, kind of relative. In that, it's all relative value. What you need to know is, okay, what is my in that is about what is my strategy, the delta hedging strategy. How much risk, how much costs. It's also hedging because it's like, say, they're liquid to big size. So there is a hedging cost, and it's more, it's some sort of optimization problem. In the end, you want to minimize your costs, right? So you want to hedge less frequently, but at the same time, you want to have your delta risk under control, right? You want to somehow, it's a trade-off between how frequently you hedge and how costly it will be.
Yeah, that makes a lot of sense. So, like, if we think about the Black-Scholes model, a lot of people will look at that as a dynamic hedging strategy. But now you're saying in EM markets, it's so wide that the more frequently you hedge, the larger sort of the scalp,
Yeah.
anti-scalp that you do. Can you, in emerging markets or these types of illiquid markets, can you just find like a liquid, highly correlated counterpart? So let's just say that like maybe Brazil dollar is a good proxy for EM markets, and then that's more liquid, and I could hedge there as opposed to hedging the direct underlying, or is that not the best approach either?
It's not the best approach.
Okay.
Usually, basis risk can be quite large. I don't have good examples now, but it could be. Yeah. To just jumping forward, right now I'm also doing some similar stuff. Like, for example, we actually, it's interesting, but maybe we can come across later. But what we do now is providing liquidity to like Uniswap pools,
Mm-hmm.
and in the end we want, if people know, like in the end we are short as a market makers. We are short convexity, like we are short options, right? And in the end now, you can formulate a problem as a dynamic hedging, right? So you are short options and you want to replicate it dynamically, right? And it's the same problem, even say for top altcoins, it's expensive. You have to be a little bit careful how you say, not that we will move the market now, but it's a bit, you cannot hedge every tick, right? You need somehow have thresholds. So it's similar problems, same solutions.
Yeah, that's really interesting. So for people who are kind of new to Uniswap or sort of these DeFi platforms, so let's just say I have a ETH BTC pool. Well, and I'm 50-50 allocated. As BTC theoretically goes to zero, I keep collecting a bunch of BTC, or I keep buying on the way down. So I'm essentially short this convexity. And if we just go straight down to zero, then I'm out a lot of money, just kind of like a short straddle if I went straight down to zero. And obviously that probably won't happen in Bitcoin and ETH, but now you're saying in altcoins, you actually have sort of the realistic possibility of this scenario. So how do you delta hedge in altcoins? And then altcoins are sort of illiquid as well. So each time you do a delta hedge, it's similar to the EM delta hedging problem that we just talked about.
Yeah, it's liquidity.
Interesting.
One notice here, with liquidity provided with BTC and ETH, it's easy because there is liquid option market on Deribit, right? And you can just buy it, right? It's okay, maybe you pay some premium, but it's a relatively simpler problem. Like with altcoins, you need to hedge it. In fact, you need to replicate this payoff.
Yeah, that's really interesting. And real quick on that topic, so back to the example that I asked about a hedging proxy. So let's just say like a lot of the altcoins are ERC20 tokens. Can you use Ethereum as a hedging proxy? That's a nice liquid market for these ERC20 tokens.
You can. We tried it. It sometimes it works, and on bull market, in bull market it doesn't work. It works when market goes down. Then kind of it's if you do some overhedging, it's good. but like they have these betas, and betas on upside is actually is higher.
That's really
Right.
interesting. That makes a lot of sense too, because in a bear market, it's kind of like everyone's pulling out of crypto, so all the assets kind of grind down lower. And you're saying you could oversell Ether to sort of match the beta of the altcoins, and that's a good proxy. But in all bull markets, you have a random altcoin that announces some new protocol development, and then the altcoin can just gap up like 300% overnight, and then your ETH hedge did nothing for you, and now you're just out a lot of money on the upside to that altcoin. Is that the right understanding?
Exactly. Yes. Exactly. Yes.
Yeah, that's really fascinating. So jumping real quick back to your previously in your career, there's some things that are really interesting. So you did a lot of sort of sophisticated volatility models. When I think about efficient markets, a lot of people would say, spot markets and futures markets are very efficient. Do you view the efficiency in volatility markets to be just as good, or is there still edge finding a good model that people haven't thought about? How do you think about that?
Mhm. Well, so first of all, when we talk about volatility trading, volatility models, for me there are three branches. So first is market making, right? You can say, and there's a different set of models. When you do market making, in the end, the best case you just collect the spread, right?
Mm-hmm.
Of course, sometimes when market is one-sided, your model should account for your inventory, mark your bid ask. I think the key is being able, whenever spot moves, you need to shift your curve accordingly, right? You have delta risks, so it's more about this kind of flow efficiency,
Mm.
right? And I mean, in the end, it's competitive business, but as long as you can collect the spread, you can collect the delta, right? You you are fine. You just like it's a supermarket, right? You collect your spreads, and the more volume you make, is the best, right? The models are interesting because you need you do some sort of Kalman filtering that every quote it needs to update your sort of your fitting, right? Any change in the quote needs to
Mm.
update your model fit. So it's interesting. The second branch is then, which is maybe more traditional, these structured products, where in the end your rate is again to have a flow. Usually it's big trading houses where they have clients across different markets, across different segments. And the best way is again you buy and sell, but different structured products. And usually because they are longer dated, you the way you make money is like you say you sell vol, maybe 1 year vol expensive, right? And you try to buy cheap hedges that you need to roll. And then,
Mm.
of course, a lot of these questions is what is my delta, right? And because and they hedge, usually people hedge first of the risk, right? If say it's long dated stuff and Vega spikes, like say vol spikes, say VIX doubles, right? You can have it's nothing right now. We have how much 12, 13, right? 25, 26 is nothing, say statistically, but for your book it can be detrimental. So therefore, people try to really use vanilla and different across different strikes, across different maturities. And requirement for a model is really to have a proper dynamics, like say how say delta bumps, how they will translate to bumps in volatility surface, how I say aggregate Vega of 1 month option with 1 year option. So this is more like a structured, and everything must be calibrated, right?
Yeah.
Because the risk is very strong, right? Or like say, you cannot take proprietary view on say on Vega or on Delta. There are many ways you can tweak the Delta, but usually first of the risk must be hedged, right? And therefore, this is more like say traditional. You have these local stochastic volatility models, Like right now, it's also interesting because they do a lot of this from quantitative investment strategies. They do a lot of flow in vanilla options. So you actually have actually synthetic supply or demand, like you can buy cheaply from this client flow, right? So it's quite good. Now I think it's much more interesting, this field, than say 10 years ago. And the last one, when we talk about volatility trading, is like a proprietary or like relative value view, right? You just have, okay, your model. If the goal is to forecast volatility, there are two goals actually. In this case, forecast volatility and forecast your hedging strategy, because in the end you want to have a good forecast for volatility that also affects your forecast on the hedging costs. And here I think this is mostly econometric models, but you can say add also kurtosis. You need to add some sort of what is my best proxy for option value, right? That's something that I can bear. I can do both. I can hedge it, right? I can, and I can bear some risk, and I expect it to be like to make some decent returns. This, I think, is the most interesting.
Yeah, that makes a lot of sense. So to me, it sounds like the structured product version is sort of the most sensitive to the correct calibration, because it's almost like you're making a market. It's like market making in terms of like elephant hunting. It's like one big customer with a big chunk of paper that's going to mature over multiple years. And now it's my job as the dealer to be able to hedge it and essentially capture that bid ask spread by appropriately hedging it throughout the term of the product itself. Whereas maybe market making on vanilla options, it's little transactions and I can update sort of my fit along the way based on flows and things like that. And then the prop trading angle, I'm forecasting vol, I'm forecasting spot vol correlations, I'm forecasting so many things that a proper fit is just one component of all my forecasts. Um, is that a good summation?
Exactly. Yes. Exactly. Because in the end, you take a view. Now you take view. You can take view on delta, like you can have whatever, say Black-Scholes delta or normal delta, right? In different situations, they have produced different delta. You can adjust your delta, and in the end, you can say make a call whether you want to buy this option or that option.
Yeah, that makes a lot of sense.
You are not flow driven, right?
Yeah, yeah. So kind of moving on to the present day. So can we touch on how you found your way into crypto and crypto vol and in your way to Clearstar Labs? What was the inspiration? Did you start following crypto when the white paper came out in 2008? Or are you more recent to crypto and crypto vol? Like what sparked that interest?
It's more recent. I think well, everyone have heard it about crypto, right? It's interesting. I mean, for a quant, it's interesting to learn something new. I came across my good friend and my former boss Alex Lipton. He published a book in 21, like a blockchain or something, blockchain technology. He gave me to proofread it, and then I saw there was some interesting problems, like, and we did a paper with him about this automated market making pools, like how you do, like, say, optimal arbitrages, like how you keep this bid-ask spread within your pool, given liquidity and fees. So that's how I felt I wanted to join. I started to look also at Deribit options because data was free. Like I built up some strategies. So I was looking for an entry point. And first I did with Signum. It's just a digital bank for wealthy people who don't who don't want to bother with wallets and with keys, like. So it was good, but it was like less exciting for a quant.
Sure.
And then it's why I saw like I joined Clearstar, because here is a real job. Like we doing arbitrage, we doing options, trading strategies, and I really like it. It's allows me to combine a lot of my prior experience with options, with say portfolio hedging, and to see challenges. Like unlike in traditional markets, there are several challenges that makes your life interesting.
Yeah, that's fascinating. Yeah, I guess a lot of the challenges kind of what you just touched on, like custody of your capital. It's not as easy as being with a prime broker and having them take care of all that stuff for you. So using a third party could be, an interesting avenue. Do you view crypto just as efficient as traditional finance, or do you think it's still very inefficient?
No, it's very inefficient. And our examples of these Uniswap pools, there's a lot of like ETH USDC 30 basis point pool. I think it's like 200 million or something. They don't make any money. Like no one makes money because it's so it's so full, right? And but money is sitting there, and we have this problem, right? We in the end we want to provide liquidity efficiently to have like return on capital, but it seems a lot of these liquidity providers in DeFi, the requirements for capital is like zero. Cost of capital is zero. I don't know why they're sitting there. For example, this side, right?
Interesting.
On the other side, of course, you have a lot of like slippage, like execution cost, right? To move your coins to different chains, it's a nightmare. It's different liquidity on each chain, different liquidity. Capital inefficient, right? It's like you wish to do more, like for good trades, but you're limited by capital, right? So yeah.
Yeah, that's fascinating. And so now, as of this recording, we're still waiting on the potential of a U.S. Listed spot Bitcoin ETF. My hope, and I think the reason we'd get an ETF is we'd get equity listed options against it. What do you think would happen to the crypto vol space? Do you think that would have any impact, or do you think it would have no impact?
I think definitely it will have an impact. I don't like to make like price prediction.
Sure, sure.
I'm like market neutral.
Mm-hmm.
But I think in Bitcoin, so for Bitcoin, the supplies of coins is very limited. The supply of on-chain coins, right? That most of the, like, say, I think it's a 90% of Bitcoin belongs to wallets that never sell. For past few years, they never sold a single Bitcoin, right? And therefore, like, I think, and if these spot ETFs, if they start buying on-chain stuff, right, there will be very limited supply. Prices can skyrocket. Again, don't take it for granted. I'm not making prediction. But of course, because in crypto we have interesting case that when you have price spikes, also volatility increases and the funding cost increases, right? So therefore, I definitely I think volatility, like next year we will see very high volatility at the money, right? So both implied and probably realized. I mean, this year in summer it was like cyclical loss of like 30%, right? You would never think of it. I think probably these days will be gone. Probably carried like even right now you can say you can lock cash and carry maybe 10% now, maybe 15%, depending where. On perps you have higher rates. But again, I think a lot of this excess capacity, like I think a lot of this Uniswap liquidity, it entered maybe 1-2 years ago when we had at all-time highs.
Mm-hmm.
When we pass through this level, I think this money will exit, and I think hopefully there will be more opportunities for DeFi to make yields on both on funding and on liquidity providing, and also in option volatility.
Yeah, that's fascinating. So, kind of just jumping on to what you said. So, if I look at the CME futures, that's an institutional avenue in traditional finance, but that's a cash settled instrument. So basically, it's two parties using their money to bet on where the future will settle to the index. So there's no necessarily direct impact on the underlying coins. But then if we go to a spot ETF, then theoretically the custodian will buy spot Bitcoin on chain, take it off, well, not take it off chain, but put it in storage in custody. So now the tradable float of Bitcoin will reduce and reduce, and therefore the volatility would increase because there's just less coins to trade. So it would take less money to move the tradable float on chain. And also that's pretty bullish because now the float is smaller, so when people want to buy, it'll just move a lot more. Is that sort of the thinking?
Exactly. Yes. Yes. I think we will have much more, not much more, but at least as previous cycle in 21, October 21, goals were above 100%, right,
Yeah.
on Bitcoin for a couple of months at least, right?
Yep.
So we may get back to those levels, and with futures, with perp yields, maybe 20-30% annualized. So it will be exciting market. Again, crypto is not efficient. So even to make those 20-30% is like, let's say, you cannot leverage, right? So there's always this, say, capacity to arbitrage, right? The capacity to arbitrage is limited, and therefore these opportunities may exist for a while, right?
Yeah, that makes sense. Yeah, I remember in sort of Q1 of 2021, we saw the cash and carry up to 40% annualized. And like you're saying, since the market's still small and you can't like leverage close that trade, that's why it persists. And the people who are paying 40% annualized, they're betting that Bitcoin doubles by the end of the year. So to them, they don't care that they're paying 40%. So it does kind of make sense both ways if your risk tolerance is high enough, I guess. Um, so
Exactly.
you recently wrote a white paper on doing some research on Deribit's inverse options. Maybe you could just touch on that briefly to anyone who would be interested in reading that paper. What sort of are your conclusions, and where could you find that paper if you want to read it yourself?
Mhm. So first, it was like there was a theoretical discussion about these inverse options, right? There was a couple of papers who did it wrong, right? That it seems obvious, right, that your inverse option is just a Black-Scholes price on dollar underlying divided by the price of Bitcoin, right? But it's not theoretically is not that obvious. So just one part was just to fix this to have really proper definition of what is inverse options and how it should be priced. The other part was interesting in a sense, also from a practical point of view. So if you're a crypto investor, right, you usually have like a two, say, share classes. One is investor who wants to have, say, he gives you ETH, and he wants ETH return, right? And the other one is dollar, right?
Mm-hmm.
Dollar investor, he wants to delta hedge in dollar, and he wants dollar return, right? So, and it's not obvious that you can say, and on Deribit you can trade only one. You can trade only ETH, right? Your collateral should be ETH, and you like all your P&L is in ETH, right? So therefore you would assume, okay, so what people usually do is like you always, if you want to be dollar neutral, you put your ETH for margin, and you immediately sell either pure or term future. So this kind of, and all your gains, you're also supposed to convert them back and forward, right? And then actually, if you say, okay, what we did, we created like a backtest, right? But we actually showed that if you do it consistently, say every day you convert your P&L into, say your ETH P&L into dollar P&L, right? Then of course it is also important that your dollar value, right? It will stay smooth. If you have an edge in selling volatility or in buying, your edge is smooth like this, right? In dollar term and the delta hedge. In ETH term, it will be volatile relative to the dollar. Relative to the ETH, it will be also smooth. So the risk-adjusted returns actually on ETH denominated strategy in ETH term is the same as kind of USD nominated strategy in USD terms.
Oh, that's fascinating.
It's not trivial, but that was part of this kind of what backtest. I created a backtest like you can, where we could like say simulate all these strategies in different account system, and also to see what is the risk premium in the end, risk premium in Bitcoin options. Just to have like say indicative, right? It's and it's there, right? We showed it's you can monetize. Of course, the best years were 20, like second part of 2020, 21. But still, you can build new market neutral strategies, and risk premium comes down a bit, but going forward, who knows, right? So.
Yeah, absolutely. Oh, very cool. And we'll link the direct link to the white paper in the notes for anyone listening to the podcast.
SSRN. I can send you SSRN link.
Perfect.
It's available, and it's written with Vladimir Lukic, who is my all-time friend, and he's Quant also.
Oh, that's awesome.
Quant by heart, and was very nice to work with him.
That is great. So Artur, so if anyone wanted a career like yours, and let's just say they're still young in their early 20s and thinking about which direction to go, what advice would you give them to have a career like yours?
Well, it's a good question. So first, I would advise to be generalist, to get like to know to study, take as many classes as you can in different subjects, like maybe in complex value analysis, in numerical analysis, in statistics, in Monte Carlo. At least it gives you like versatility. We don't know what's next, right? When I studied, it was like probability, it was like measure changes, was like this Monte Carlo stuff. Like now it's all about time series and data science. Like if you have a good background, you can prepare to anything, right? Maybe in future it will be like large language models. Maybe we just tell computer what to do, and it will tell us. But we need to know how to say it. This is first advice. Second is, as possible, invest in your network. It's friends, like peers, maybe senior colleagues. Go. When I was like the beginning of my career, I went to any events possible, right? To see what's going on. You learn a lot from talking to people. Like you also see the directions, what's moving, what is interesting. You also feel what people feel about, right? It's sometimes it can be something looks interesting, but when you talk to people and they're absolutely not motivated, then right, you save your time, move on and find different. So and also professionally it helps a lot. Like if you with career changes, and also like you need to have good network of say professional friends that you can discuss your professional style, like say work, like it helps a lot. So sometimes can save a lot of time that then you can ask advice, and network, and network.
Oh, that's fantastic. I really like that. That wasn't the answer I was expecting from a quant, but that's really that's really cool. Speaking of which, we actually met through Euan Sinclair, who's a mutual friend of ours.
Yeah,
How did you meet him? How do you guys know each other?
well, actually, I met him at a conference in person, but I think yes, he already published his book, and
Mm.
of course he was. I knew him, but we met in one of these events and in person. I think we continued. We had sometimes we cross some emails. We just I see what he's doing. Like we wanted to write a paper together, but still, I think maybe one time, yeah, one we should.
Yeah, absolutely.
And
Cool. And then so just kind of wrapping up here with just some last two little personal questions. One is, do you have any favorite books in the industry that either helped you with your quant career or options or anything like that?
mm, with options, I think I would definitely recommend Euan Sinclair. Like
Mm-hmm.
he has, I think, 3 books now. Uh, is There is also, I think, Bennett, Trading the Skill is good book. Is about more structured products.
Oh, cool.
Then yeah, there are a few from trading book from more general. I think books is it's I like this one. He is expected return human. It gives a bit of more like say how quant models like fits into this kind of risk premium picture and how you can say monetize your bond models like this kind of a lot of this how you translate mathematical features into signals, right?
Oh,
that
that's
that
fantastic.
that is good.
Yeah, that's fantastic. And to listeners, we'll make sure to put links to all these books in the show notes. And then Arthur, last question: when you're not working at Clearstar Labs or doing quantitative modeling, what do you like to do for fun outside of work?
Good question. So I'm a big fan of jiu-jitsu.
Oh,
I
nice.
Brazilian jiu-jitsu. I started before COVID, then I had a break 1 year, and now I think it's 2.5 years continuously. I love it. I
Wow.
already did my lunch training. I try to go every week, maybe 3 4 times, and on weekends I go to open mats. There are a few clubs here in Zurich, and they have open mats where you can go and compete with the other guys. So I love it. I think it's a difficult at the beginning, but it's also uh, trains your stamina, your resilience. Once already pass, say after 2 years, you already see you understand the game.
Oh.
Now I'm blue belt also. So for me, like say I can play with white belts, I can master my techniques. But every time I spar with black belts, it's so I also like. Of course, I'm not as good yet, but it's good. It also teaches you a bit of humbleness. It's always it's good that you like say went through like for a few
Mm.
years, right? But then some people do train more than you, and it's visible.
Wow.
So
That's
it's good.
cool.
So,
Yeah, I've heard a lot of great things about BJJ. Like, it's supposed to be one of the best workouts, and also in terms of self defense, they say most fights end up on the ground right away. So having a good ground
yeah,
game is supposed to be pretty good. Well, Arthur, thank you
yeah,
so much for coming
exactly.
on. It was really interesting to talk to you. I think listeners learned a lot. And I really appreciate it.
Thank you, Greg.